It did tell me recording is in progress.
I think we are. We should be live. Okay, let's allow for people to join for another minute or so. But to the ones that have already joined, welcome and thank you for joining this FX market update. I just wanted to mention that we will be hosting these global market updates every quarter from now on. So keep an eye out on our social channels and on our websites to see when the next one will be. After the presentations, there will be some time for Q&A, and hopefully Enrique and Matthew will have enough time to answer all your questions. If not, you can always get in touch with them via their details. We will send you the presentation and the recording afterwards. Enrique Diaz-Alvarez is our Chief Risk Officer. He will be doing an introduction. And then after that, our Senior Market Analyst, Matthew Ryan, will be giving you the full update. Yeah, that's it from my side. Over to you, Enrique.
Okay, thank you for joining us. We intend to make, just by way of background, we'd like to make this macroeconomic and market updates with a quarterly frequency. We think that's enough to keep up with the main things that are happening out there. And I would like to inform you what has happened, the most important events that have taken place in the world of economics and finance, and with a particular focus on the currency market, which is Ebury's specific purview. So we go to the next slide. We will, even though the focus of the presentation is going to be on the recent inflationary pressures and what it means for markets, we'll also inevitably need to cover the latest numbers from the COVID pandemic and the impact on the economic recoveries of the different paces at which the different economies are lifting the lockdowns. And inevitably, when talking about inflation, we need to talk about central banks, and we need to talk about how they're reacting or not reacting to inflation. So we will inevitably be focusing a lot of our time on what's going on in the central banks around the world. Then one specific area where Ebury has been pounded the table quite a bit for the last few months is the fact that the current macroeconomic and policy environment worldwide is particularly positive for emerging market currencies. So we'll go in some detail as to whether we think that that's still the case and how long will continue to be the case. And then we'll have some time, hopefully, for Q&A. Go to the next slide. The main themes around markets have not changed too much the last couple of months. The economic recovery is going generally faster than expected. Most forward-looking indicators, inflation, has continued to surprise to the upside, even as strategies revise their expectations higher. Both the leading indicators of economic recovery in the main economic areas continue to come higher than those freshly revised expectations, in particular inflation. Most economic areas are going to post very solid growth in the second quarter. And what is happening that is a little bit different from the previous recoveries is that inflation is rising globally. We have a combination of pent-up demand. Consumers were restricted in their ability to spend money in the pandemic, but for the most part, because of the various programs of fiscal support, their incomes did not suffer nearly as much. So there's tensions in the supply chains. I'm sure that a lot of you are familiar with those. There's shortages, there's prices spiking up. And the question that everybody's focusing on is this spike in prices, are disinflationary pressures temporary, something that will dissipate over the next few months, or are we looking at a more structural change in the relationship between demand and inflation? Then again, not a major change of the last couple of months, but major central banks maintain the view that these inflationary pressures are really nothing to worry about. the Federal Reserve. Today we had the ECB meeting where the decision on whether to take into account the possibility that these inflationary pressures are going to last longer than expected, what was essentially punted to the September meeting. So for now, some major central banks, at least in the developed world, continue to commit to extremely stimulative policies that will not change because of the rather severe spikes of inflation that we're seeing right now. We go to the next slide, please. Something that is a little bit different, in addition to the inflationary pressures, the other aspect of this recovery that is different from past recoveries is that even though the United States is leading the economic recovery in advanced economies, partly because of the strength of the stimulus there and partly because of the success in rolling out vaccines faster than most other economic areas, interest rates in the US have increased significantly so far this year, from very low levels and still to quite low levels considering the levels of inflation of growth. But nevertheless, US rates have risen in line with this economic outperformance of the United States. And yet the US dollar, contrary to the experience in most of the recent recoveries from recessions, has actually gone down so far in the last 6 to 7 months. The explanation for this is that, in our view, is the massive shift in the tone and the priorities of the Federal Reserve. Not only have they ignore or not ignore, but commented on, but expressed their intention to see through any short and medium-term inflationary pressures, keep rates at 0%. Keep purchasing an enormous amount of U.S. Treasury debt, but also they have made it clear that even if over the next few months and years inflation averages above target, they will not be concerned because they will see that as payback for the years where inflation was below target. That is a massive change in the stance of the Federal Reserve. It's a pro-inflation it's an inflationary change in mindset, and in our view, that's what has caused the U.S. dollar to not behave particularly well in the first stages of this recovery. We think that this is a structural shift on the part of the Federal Reserve, and therefore we expect no reason for the trend towards a weaker U.S. dollar to change over the next few months and even years. So if we go to the next slide. This is a listing of the G10 currencies and how they have performed so far in 2029. We see that, not surprisingly, given this inflationary environment, given that has produced a sustained and significant rally in the prices of commodities. Commodity-dependent currencies like the Canadian dollar and the Norwegian kroner have performed extremely well. Whereas the currencies that are traditionally seen as safe havens, like the Japanese yen and the Swiss franc, have performed quite poorly. Again, an economic environment of strong economic growth, inflationary pressures, and monetary stimulus, rates at zero, and the implicit or explicit promise on the part of central banks to keep it this way is favorable to risk-taking in general, and specifically risk-taking in currencies that benefit from this inflationary boom, i.e. the Canadian dollar and the Norwegian krone. So if we go to the next slide. Again, it cannot be overemphasized how positive the current environment is for any sort of risk assets, in particular risk assets that have some sort of built-in protection against inflation. In this case, stock markets, investors in the stock market, presumably, at least the pricing power of the companies represented in the stock market will at least benefit partially from the inflationary pressures. And in the absence of fixed income instruments that provide sufficient interest to protect against these potential inflationary measures, let's not forget that even after the current backup in yields, the real rate, i.e. the yield that is left over in a 10-year treasury note after we discount future expectations for inflation, is actually below zero, deeply negative of almost -1%. So in a sense, a 10-year treasury note is almost a guarantee to lose money over time. And in this environment, it's not surprised that risk assets, in particular stock markets, are doing very well. Frankly, as long as the Federal Reserve and the European Central Bank maintain their dovish stances, I don't see any particular reason for this to change in any significant way. It's not part of our remit, but personally, I'm quite bullish in stock markets for the remainder of 2021. Now, to me, the big risk is what happens if these inflationary pressures prove to not be transitory, prove to be a new structural part of the economic landscape, and these central banks that have taken such a relaxed view of the problem have to overcorrect in 2022 and increase rates considerably faster than the market is expecting. That is the big risk for risk assets, but I don't see that happening until well into next year at the earliest, if it does happen. So I think here I will hand over the baton to Matthew, who will go into more detail about how the pandemic is evolving and how the different areas, economic growth and inflationary pressures are proceeding.
Yes, thank you very much, Enrique, and thank you everyone for joining today's webinar. As Enrique mentioned, we're going to move on and talk about our first sort of main topic of today's presentation, and that's also the COVID-19 pandemic, its impact on the FX market. I'm not going to spend too much time on this section because actually the pandemic has become much less important for the market in the last few weeks, certainly compared to the first few months of the year. As vaccines are rolled out to the masses in some of the major developed nations, restrictions are being unwound to a fairly meaningful extent. The actual contagion numbers, even vaccination numbers, become much less relevant and have taken on less importance for the market. Of course, the situation as well is considerably improved on earlier in the year, as we all know. Daily caseloads among the G3 nations, as we can see on the chart on the top right-hand side, have fallen fairly dramatically. If we look at the US and UK, for instance, new daily case numbers are down anywhere between sort of 90, 95% or more from the peak around about the turn of the year. And even in Europe, they experienced the third wave of infection in March and April. Case numbers have fallen dramatically again. And we're seeing economies reopened, some at a relatively aggressive rate, certainly the US and the UK. Of course, hospital admissions, deaths also down, which is very encouraging, and of course made possible by the vaccines, which are proving highly effective and probably much more so than the market had expected, even as recently as late last year. The risk to reopening, of course, are these new variants. The one that seems to be the most concerning, or seems to be taking up most concern among governments and politicians, certainly in the UK at least, is this Delta variant, the one first detected in India, which is said to be up to sort of around, I think it's about 40% more transmissible than some of the other variants. So that could present a little bit of a risk to reopening later in the year, but none of these variants have proved completely evasive to the vaccines, and we're still very optimistic that we'll see returns to near normal economic capacity in most developed nations in the second half of this year. Regarding the vaccination efforts, again, as I mentioned, the vaccination numbers have taken on slightly less significance in the market in the last sort of 2 months or so. Certainly the first quarter of the year, I think that the vaccine rollouts were just about the most important driver for currencies. Certainly, I would say in the top 2 or 3 drivers for currencies in the world. And currencies were performing largely based off the performance of these rollouts, vaccine rollouts. Sterling, for instance, was at one stage the best performing currency in the G10, driven largely by the rapid rollout of vaccines in the UK. Canadian dollar is another currency that's performed rather well in the last 2 months or so, partly, of course, due to the increase in commodity prices, but also because of the rapid rollout of vaccines that we've seen in Canada in the last sort of couple of months or so. And of course, euro dollar, which in the first quarter of the year sold off relatively sharply, partly because of the economic outperformance of the US relative to Europe, but also because we saw this divergence in vaccine performance. As you can see from the chart on the left-hand side, this is daily vaccine doses administered. You can see the US is a darker blue line, the EU is a lighter blue line. You can see the first sort of 3 months of the year, we saw a pretty big divergence whereby the US was powering ahead and the EU was lagging behind. In the last couple of months or so, since sort of mid-April time, we have, however, seen a bit of a shift whereby daily vaccinations in the US have collapsed. And in Europe, we've seen a sharp increase in the pace of vaccinations as supply has increased. I believe around about 70 or 80 million doses were administered in the EU in the first 3 months of the year. In the second quarter, supply is expected to increase to around about 400 million doses. That's a significant leg up on the first quarter of the year, and that's provided a little bit of support for the euro, which is, of course, has recovered its losses from the first quarter. We're still seeing a relatively loose relationship, I would say, between vaccination progress and currency performance, although it's not as strong as it was, as I said, earlier in the year. But we are still seeing currencies such as a pound, the Canadian dollar, at the top or near the top of the performance rankings. Those are two of the countries that have rolled out the vaccines to the greatest share of the population in the G10. And currencies such as Australian dollar, New Zealand dollar, Japanese yen as well, I think they've been held back slightly by the vaccination pushes in those countries, and have held them back from posting gains. I mentioned the US vaccination effort has slowed since mid-April. In fact, it's collapsed. So the daily pace of vaccinations has fallen from around 1 dose administered per 100 people per day to around about 0.3. So it's around about less than a third of the pace as it was in mid-April. Now, part of this is due to supply, but also I think we're seeing less incentive for one among the population. Now that restrictions have been unwound fairly significantly, there's less incentive for the population to actually go out and get the jab, similar to what we're seeing in likes of Australia, for instance, which has very low vaccine uptake. Also, I think as we get through to the younger generation, the hesitancy, vaccine hesitancy among the younger demographics is much higher. And we can see from this chart here, so this represents, on the left-hand side, this sort of blue shading area is those that have been vaccinated or those that are willing to be vaccinated. The red shaded area on the right-hand side, those that are unvaccinated and are either unwilling to get the vaccine or unsure as to whether they want the vaccine. And you can see for the US, it's a relatively large share of the population. Almost 40%, in fact, are either unwilling to get the vaccine or unsure. If we compare that to the UK, for instance, it's something that's around about 16% compared to 40%. And actually, similarly to many European nations, not all, but most, it seems to be around about 70-30, 70% in favour of the vaccine, 30 not in favour. So I think that could present a little bit of a challenge to reaching herd immunity in the US. In the winter months, it's not so much of a problem at the moment, but as I say, we do get towards those winter months. I think this may be something that comes back around and comes more to the fore among investors, as I said, as we get towards those winter months where the virus tends to thrive amongst the population. Having said all that, the vaccine rollouts have been going very well. Virus restrictions have been unwound to a fairly significant extent in most major nations, particularly so in the US. We can see from this chart here, so this represents the COVID-19 government response stringency index. The higher the index, the tougher the restrictions, the lower the index, the looser the restrictions. You can see for most nations, we've seen a fairly material unwinding in restrictions. I've put on here the US, UK, and then the France and Germany is sort of a proxy for the Eurozone. And in the US, restrictions have been unwound very aggressively. The index here is its lowest level since the start of the pandemic. Similarly, in the UK, we've seen a very sharp unwinding in restrictions. Pretty much all of the major restrictions in the UK are now gone, and we're hopeful that we'll see further unwinding on the 21st of June, and we'll get further news on that in the next few days. And even in Europe, that of course has suffered from this third wave of infection, have been slightly slower on the vaccine rollout. Even there, we're seeing an unwinding in restrictions. And so we're very confident that we'll see strong rebounds in the major economies in the second half of the year. Now back over to you, Enrique.
Thank you, Matthew. If you go to the next slide. So as we were saying at the beginning, the global economy recovery is picking up pace very nicely. The data has tended to come in significantly, definitely above the expectations that most people have had 3 months ago. Even now, we have activity. The leading indicators of economic activity tend to surprise on the upside. Here, I'd like to make a little bit of a detour into the PMIs. The PMIs are indicators of business activity where managers of actual companies are asked every month in a survey whether they're seeing their business increase, decrease, or remain the same. Basically, a level of 50 would mean that the same number of managers are seeing their business increase as decrease. Anything above 50 is indicator of expansion, and anything above 60 tends to be a very, very strong indicator of booming conditions. This is very important because most macroeconomic indicators are by nature backward looking. Employment, GDP growth, these are all very important, but generally come out lagged and give us an impression not where the economy is going, but where it was in the rearview mirror. So looking at the PMI indicators of business activity, we have that all of the major areas, the US, the euro area, the UK, not pictured here by China as well, are consistent with very, very strong rates of expansion. Particularly in the US, less so in the Eurozone, and the UK, as usual, somewhere in between those two. The global economy is expected to expand by 6% in 2021, following a 3.5% contraction in 2020. It is likely that the US, for instance, the economic activity levels will return to pre-pandemic levels much earlier than people were expecting last year, perhaps even as early as this year. And again, it cannot be overemphasized how rare it is to see these booming economic activities, indicators of economic activity in the context of enormous monetary and fiscal easing that is still in the pipeline, and that nobody is as yet really discussing even the possibility of withdrawing it. So if we go to the next slide. Let's focus on the US. Like I said, the economic data there, the recovery has been leading by perhaps a quarter. The recovery in the US seems to be leading that in the Eurozone by roughly 1/4, partly because the virus restrictions were never as strong in the US as in the Eurozone, partly because the initial rollout of the vaccines was much faster in the US, and therefore, while the European countries were grappling with third waves and even fourth waves, the US was able to, most US states were able to lift whatever lockdowns they had implemented. And finally, because the mode taken by US fiscal support for the economy was direct payments to consumers that show up very quickly in their bank accounts, as opposed to the European, the Eurozone, and to a lesser extent the UK approach, which is to hand over significant amounts of money to the states to distribute, which will not be happening until this quarter. So it's, again, we're not talking so much a difference in the level of support, but a difference in the timing of the support. In the US, the timing, the expenditures in support of the disbursements in support of consumers and the economy through the pandemic were much more direct and took place much earlier. Now, we'll go into detail in the next slide, but the important thing to remember here is that for the first time in many, many years, I think that this is at least going back to the housing bubble back in the aughts. We think that what is holding back the US economic expansion is not insufficient demand, but rather supply constraints. Backlogs of orders in manufacturing at all-time highs, pricing pressures reported by the business managers in the PMI indices that I explained, that I discussed in the previous slide, are also near all-time highs. There's specific shortages of chips for manufacturing all sorts of consumer goods, in particularly cars, are in backlog. There's lumber shortages that are constraining the ability of the housing sector to meet this booming demand for houses in the US. So if we go to the next slide, the labor market has yet to fully recover. And here again, we think that for the first time in many years, we're seeing supply constraints, supply side constraint rather than demand constraint. The reason why payrolls are growing in the US, not as fast as it was expected. The gap between the number of jobs now and those between before the pandemic is still very significant. The April and May payroll reports fell so much of expectations. And the reason here is not that businesses are worried about the future, about having sufficient demand and hiring, which was what held back hiring, for instance, in the recovery of the great financial, in the great financial crisis back in 2008, 2009, 2010, but rather their inability to find workers. The reason for this is that the labor market has been disrupted in a variety of ways. There's been a lot of worker relocation as a result of the pandemic, work for home, etc. Many public schools are still closed. Workers are unable to find childcare or cannot afford it. And finally, there's some temporarily very generous unemployment benefits that are making it easier for workers to delay their job search while all these other issues get resolved. So this is, we think that this problem, the specific problem of having difficulty matching workers to open positions, which is clearly, we're seeing that in the United States, will be much less of an issue in the Eurozone because of the different approach taken by European countries to protecting businesses through the pandemic. In the US, businesses were allowed to or were asked to lay off workers freely to the extent that they didn't have the demand because of the lockdowns, and now are having trouble rehiring. In the Eurozone, by contrast, is more difficult to lay off people for short-term reasons, and the various states focus instead on keeping payrolls and companies intact and subsidizing that payroll. So we think that there's this difficulty that the US is encountering in matching workers to open jobs. The Eurozone, where payrolls have experienced much less destruction and therefore employers need to rehire as much less, this will be much less of an issue, we hope. So if we go to the next slide. Again, by contrast with this sort of sluggishness in the labor market, we have consumer spending growth in the US very strong. Retail sales are exploding back to levels even above before the pandemic. The Biden stimulus package signed off in March of $1.9 trillion. It meant direct payments of up to $1,400, $300 a week on top of unemployment insurance supplements. Again, there's this bubbling demand, this supply side that is constrained both by labor and supply chain issues, And the inevitable outcome of these two forces competing is higher prices. Central banks remain very, very confident that this shortages and this pricing pressures are temporary. We're less convinced of that. So if you go to the next slide.
Yeah, I think I'll take over from here. So,
yes, thank you.
Yeah, as we mentioned, the recovery in the euro area, which we'll get onto in this next couple of slides, it's been slightly more of a delayed and gradual nature than what we've seen in the US, partly due to the third wave of infection, of course, we've seen in March and April, and the slower vaccine rollout that we've seen in Europe relative to the US. So the economy contracted again in the first quarter of the year, 0.3% quarter on quarter, following on from a 0.6% quarter on quarter contraction in Q4, which triggered the Eurozone economy to enter into a dreaded double dip recession, whereby one recession is followed very quickly by another. And you can see from the chart, just 1 quarter of growth separated the two recessions. Actually, if we look at the Eurozone on a whole, while the Eurozone economy enters into a recession, many of the major nations in the bloc didn't. Some contracted in Q4 and expanded in Q1 or vice versa, with a few exceptions. I think the issue really for the Eurozone relative to a lot of its peers, of course, it's been that the slow vaccine rollout has not helped. But I think during the pandemic period, the structure of the Eurozone economy has also weighed on its performance. Unlike, say, the US, UK, Eurozone is much more reliant on external demand. The US, for instance, is very consumer demand driven, domestically demand driven. Whereas the Eurozone, of course, much more heavily reliant on the likes of tourism, exports, for instance, which is obviously not ideal during a global pandemic. And so that's had a significant hit on the Eurozone economy. But we are seeing signs of rebound. As I said, it's been slightly more of a delayed nature, gradual nature than what we've seen in the US. But we are beginning to see restrictions unwound as the vaccine rollout picks up pace. France, for instance, I believe this week has recommenced indoor dining, for instance. Italy has done similar and is in the process of removing curfew measures. Germany, even a country such as Germany, where the restrictions have been much tougher this year than a lot of its European counterparts, even there we're seeing restrictions being gradually unwound. So we're pretty optimistic we'll see a strong rebound in the second quarter in the Eurozone, and certainly we'll get an even stronger rebound, we think, in the third quarter once the majority of these restrictions are gone. And we're beginning to see that be reflected in economic data. The data out of the Eurozone economy has been largely encouraging in recent weeks. Enrique's mentioned about the PMIs, the leading indicators of economic activity. They're all trending in the right direction. As you can see from the chart on the left-hand side, actually the manufacturing sector has proved very resilient during the pandemic period, posting growth in every month since mid-2020. It's been above that key level of 50 that denotes expansion. The services index has lagged behind somewhat, although that's still trending in the right direction, has moved back above the level of 50, back up to 55.2 in May, which is the highest level since June 2018. So that does suggest we're likely to see a solid rebound in growth in the second quarter. And actually, other broad indicators of activity have been pretty impressive as well. We're seeing an uptick in business and consumer confidence. I think consumer confidence is the highest level since 2018, which suggests that we're likely in for an uptick in domestic demand in the coming months. Indicators of consumer spending have been relatively mixed in the last few months. Retail sales growth has been rather uneven, but I think that's to be expected given the uneven nature of the removal of the lockdown measures. But overall, we're optimistic, as I said. Data is pointing in the right direction, and we're very confident that the EU will begin to close the gap in economic performance, with the US in the second quarter, and very much so in the third quarter of this year. On to the UK now, and the UK, of course, one of the economies, major economies that was one of the worst affected from the lockdowns in 2020. It suffered from one of the worst contractions of all the major economic areas of countries last year. But we think that UK economy has very much turned a corner in the last few months. We did, of course, see another contraction in the first quarter of this year. The UK economy contracted by another 1.5%. Although it did avoid, unlike the Eurozone, it avoided a double-dip recession, having posted modest expansion in the fourth quarter of last year. As envisaged, I guess, at the beginning of the year, we thought that the currencies of the economies that suffered the worst during the lockdown periods last year would probably be the currencies that benefited from the most from the vaccine rollouts. And that's indeed what we've seen, certainly as far as the pound is concerned. As we've mentioned, sterling's been one of the better performing currencies in the G10 so far this year, behind only the commodity-dependent currencies. We think in large part due to this improvement in the growth outlook, the rapid vaccine rollout, and the pretty swift removal of lockdown measures that we've seen in the UK. As we mentioned, most restrictions are now gone in the UK. We've seen indoor hospitality, indoor leisure, cinemas, hotels, all opened. I believe it was on the 17th of May. Shops as well, all opened way back in the 12th of April. And we're hopeful, as I said, that we'll get all of the measures removed on the 21st of June. It's just 11 days away. There is a strong possibility that this date could be delayed. There's suggestions that we could see a 2-week delay in this date in order to allow more of the vulnerable people to be fully vaccinated and to build up immunity. The big concern, as I mentioned, is this Indian variant, which seems to be the most aggressive spreading of the lot. But regardless, I think we're still pretty confident we'll see all the restrictions gone at some point in the next few weeks. And certainly we're very optimistic that we'll continue to see a strong performance in the UK economy in the second half of this year, which could very well provide some good upside support for the pound. And indeed, data out of the UK that we've seen in the last few weeks has been very strong. Been particularly impressed by the rebound in consumer spending in the UK, which suggests that I think we'll broadly have the consensus the UK economy will be one of the better performers of the majors in the second quarter. Certainly, I think it's going to outpace the Eurozone. As we can see here, retail sales growth provided a good indication of that uptick in consumer spending. Sales jumped by over 9% month on month in April. It was the second consecutive month where retail sales blew past expectations. More than 40% jump on this time or on the year previous. That has to do with the base effect. So of course, the April last year was the height of the lockdowns. And so it stands to reason that we see a big year-on-year jump on last year. I think this data probably made all the more impressive, really, that high street retail shops were not open until the 12th of April. So I'm hopeful that we'll see more of the same in the May report, which would be the first full month where we see high street retail shops open. As we mentioned, the PMI data is trending in the right direction. The composite PMI has surged to a record high, 62.9 in May, which bodes well for overall activity in Q2. And the jobs market has held up very well in the UK, in large part due to the UK government's furlough scheme, which was extended until September. Unlike the US, the UK has placed a very high importance on job retention during the pandemic period. That's allowed the jobless rate to remain rather contained, certainly relative to the US, and actually unemployment ticked down again. The latest reading is just 4.8%. And the Bank of England actually not overly concerned that we'll see too much of an increase in unemployment once the furlough scheme ends in September. So it's all encouraging signs. I think, yeah, as I mentioned, I think we're confident that the UK will outperform most of its peers in the second quarter of this year. Back to you, Enrique.
Thank you, Matthew. So let's go do a little bit of a deep dive into inflation. What is happening? What is driving inflation? What is the reaction or lack thereof of the fiscal and monetary authorities, and what that means for markets in general and in particular currency markets? Again, at the danger of repeating ourselves, the inflation is rising globally. It's a global phenomenon. It's rising even more sharply in emerging market economies where commodities have a much bigger weight in the consumer basket, but they're also rising the prices are also rising all along the supply chain and onto the consumer. Today, we had the latest shocker out of the US for inflation for May. Surprise to the upside again, is running a 5% headline. And more importantly, the core index, which strips that volatile component, is running at the highest level since 1992. Citi keeps a very useful inflation surprise, which measures not so much whether inflation is high or low, but whether economies are surprised, whether the economy's expectations are below or above the actual inflation. And inflation has been coming on relative to expectations at the highest level since right before the great financial crisis 13 years ago. This ordinarily would present a challenge for central banks, but central banks have decided to, for the most part, and here we're seeing a bit of a divergence between developed countries and emerging market countries, in that developed countries have decided to see through inflation, assume that it's going to be transitory, whereas most emerging market major central banks are taking action already and have made it clear that rates are going to go up or are going up already. So what are the factors driving prices higher? Let's go to the next slide. Again, the main factor, as always, is the highly accommodative fiscal and monetary policy. Let's not forget the monetary policy in pretty much every single G10 country, every single major economic area in the developed world. It's at 0% or below. We have negative rates in a number of countries, especially notably the Eurozone. Not only that, but because of the pandemic, in a completely logical and understandable reaction to the pandemic, in addition to the normal fiscal stabilizers and the normal deficits that countries would run in the context of a sharp recession, there's been additional stimulus programs that have put government deficits at double digits in terms of a percentage of GDP in most of those countries. And we had a second round of such programs in the US, and now we're going to see the impact of the first round in the Eurozone. So in combination with this massively accommodative fiscal and monetary policy, we have consumers whose income was held off through the recession, through the pandemic recession, relatively well. This was a very unusual recession in that income, through this partly because of this government support programs, held up very well, but their demand was constrained by the lockdowns. People could not go on vacation, people could not go out to restaurants, etc. So now that these lockdowns are easing, we're seeing this pent-up demand bubble up to the surface, and inevitable the interplay between this pandemic restricted supply chains and this pent-up demand by a consumer that has actually been able to save money through the recession is inflationary pressures. The one place where these inflationary pressures have expressed themselves first is, as usually is the case, rising global commodity prices, where not only do we have worldwide increasing demand, but also a sector, the global commodity sector, where there has not been a lot of investment in production and exploration since the global commodity prices crash of 2014. So most of that inflationary tension now is being seen in rising global commodity prices. In addition to that, and is less obviously in terms of pricing pressures, but is manifesting itself in shortages, is the supply shortages that we're seeing over specific critical items whose supply chains were disrupted over the lockdowns. In particular, there's two chips. Chips are critical elements in a variety of consumer goods, in particular cars. We're seeing supply chains bottlenecks in those industries, which are only partially being transmitted into higher prices. They're also resulting in shortages and de facto rationing. And to be honest, there's also a purely mathematical effect, which is because the initial reaction to the lockdowns was deflationary and prices dropped. We're seeing we're measuring inflation from a very low base when we look at year-over-year numbers. But this is becoming less and less of an issue as we go on, because when we look at 3-month annualized rates of inflation, they're really exploding. I mean, the US we had today, the less volatile, the core index, which is an index that has generally difficulty moving either up or down as in a very volatile manner, is now running at 8.3% annualized over the last 3 months, the highest level since 1992. If we go to the next slide. Again, this is very timely. Today we had inflation, highly awaited inflation report in the US for May. Headline inflation is up to 5% on the year. Again, this is partly, but only is partly explained by the fact that we're using a very low level of prices as base, May of last year. Core inflation, which is I think much more significant, because when the core inflation diverges from headline inflation, is generally headline that comes back to core, or the other way around. But core inflation is also up to 3.8% on the year. Again, if you look at just the last 3 months, annualize it, 8.3%, higher since 1992. The PCE index, Personal Consumer Expenditures Index, which is probably the one that the Federal Reserve claims to pay most attention to, is also 3.6% year on year. So we're not talking about an artifice of the way a particular index is built. We're talking broad-based inflationary pressures. The prices paid index in ISM manufacturing, remember, here used to subtract the manufacturers that are seeing higher prices from the ones that are seeing lower prices. And it's up, I believe this must be an all-time high of 88, which is almost every single manufacturing operation in the US is seeing higher prices. In spite of this, the members of the Federal Open Market Committee, the officers that are charged with driving and setting US monetary policy, have remained very dovish. They claim that this is temporary and they expect this spike in prices to fade away. They're not very explicit on the timeline for when they expect it to fade away, but definitely no later than the fall seems to be their expectations for this inflationary pressures to ease. Our guess is that for both the European Central Bank and the Federal Reserve, if, as we expect, inflationary pressures do not ease over the summer, if leading indicators of inflationary pressures, like this ISM price paid indices, if they do not ease, we're going to see the first serious debates in both the Federal Reserve and the European Central Bank between doves and hawks as to how strongly they can rely on their intuition that the inflationary pressures are going to abate without any need for tightening of monetary policy. If you go to the next one, UK inflation is also creeping higher. Again, the UK, in terms of the timing of the recovery, is somewhat faster than the Eurozone, but much slower than the US because of both the timing of the rollout of the vaccines and the timing of the lifting of lockdowns. But here we're already seeing what we were seeing maybe 3 or 4 months ago in the US. UK inflation rose to 1.6% year-on-year, still nothing to worry about, still well below target, still below the target, but the highest in the start of the pandemic, and all being driven by a booming demand. The Bank of England has already said that it expects 2.5% inflation in 2021, has indicated it will look through temporary spikes in prices. But I think it's notable that some of the members of the Monetary Policy Committee are starting to make the first hawkish noises. And we wouldn't be totally surprised if this time around the Bank of England was the first of the 3 major banks in the developed countries to react to higher inflation and start pushing up rates even before the US does. I think if this is the case, this would be a very significant positive for the pound in the FX markets. Go to the next slide. I will pass the baton here back to Matthew.
Yes, thank you, Enrique. So the key now really, of course, we talked about higher inflation globally. The key is, well, how are central banks going to respond to that? We've seen, I guess, contrasting views among central banks around the world. Many emerging market central banks have already begun hiking interest rates in order to rein in rising prices. We've seen that in Russia, we've seen that in Brazil, and some of those in Eastern Europe have indicated that higher rates could be on the way soon. We've also seen among the major central banks, the Bank of Canada, for instance, was the first major central bank to begin winding down the pace of its asset purchases. The Reserve Bank of New Zealand as well has also indicated that it may well begin hiking interest rates as soon as the 3rd quarter of 2022, which is much sooner than a lot of its peers. But we're going to focus on the 3 major central banks in the next few slides, starting, of course, with the Federal Reserve. And actually, the Fed has had a relatively mixed impact on currency markets so far in 2021. We had earlier in the year Jerome Powell, the chair of the FOMC, stated it was relatively unconcerned with the spike in US yields we saw earlier in the year. We had that on the one hand, but on the other hand, as we've mentioned, the Fed has voiced its suggested it's relatively unconcerned with the recent increase that we've seen in US inflation, which is now well above the Federal Reserve's target. A number of FOMC members have spoke in the last few weeks since the inflation news and suggested that they continue to believe that this spike in inflation will prove temporary, and they've listed a number of factors as to why they believe that's the case. And they expect these supply shortages that we have, and they expect those to prove short-lived. And once supply catches up with demand, that could potentially drive down prices. For instance, if we look at car manufacturers over the lockdown period, have had relatively limited inventory, and now the demand is booming again. It's going to take a little while for those car manufacturers to replenish their stock. Once they do, prices should begin to ease. A number of Fed members have suggested there's a relatively loose relationship between the labour market and price. So wages and incomes in the US have been well supported by Biden's stimulus program, but a number of Fed members have suggested that actually this increase in wages is not necessarily going to feed through directly to the increase in prices. And also, as we mentioned, the base effect should eventually pass out of the index, given that the shutdowns experienced in 2020 have sort of elevated the year-on-year data. But the key really, I mean, the key is whether this spike in prices does indeed prove temporary. If not, as we've mentioned, I think there's going to be some serious discussions to be had in the Federal Reserve in the next few months. There's a meeting coming up next week at the FOMC. We're of the opinion that, I guess, regardless of whether we see this spike in inflation as a prolonged one, I think the general consensus among the FOMC is that they're sort of gearing and edging towards the need for normalization. Certainly, as far as the quantitative easing program is concerned, we think that we could get news in the summer that discussions are being had as to when to begin winding down the QE program, with an announcement broadly expected by the market sort of the end of this year, towards the end of this year, or maybe early 2021. But interest rate hikes still remain quite a long way off. And we think they'll leave a decent gap in between ending the QE program and hiking rates. That being said, we will get a revised dot plot, which is where policymakers indicate where they think rates will be at the end of each year over the forecast horizon. That will be updated next week. Given the recent inflation surprises since the March meeting, we think that the median dot could potentially be revised higher to show hikes over the forecast period. And that may well present a little bit of an upside for the US dollar after next week's meeting. As far as the ECB is concerned, I think the ECB has been the most dovish of the lot, and probably with good reason, really, given the underperformance of the Eurozone economy, the rather slower vaccine rollout that we've seen so far this year. But even the ECB is slightly more upbeat at its meeting this afternoon than it has been in recent meetings. Lagarde upgraded the balance of risks from broadly balanced to, broadly balanced from tilted to the downside, which was the previous assessment. GDP and inflation forecasts for this year and next were also revised higher, as expected by the market, and the ECB is now expecting inflation to rise to 1.9% in 2021 from the previous 1.5% projection. But we've had no word from the ECB yet on whether it will begin tapering the pace of its asset purchases, which were increased earlier in the year in light of the slower vaccine rollout and the prolonged lockdowns that we've seen in Europe. Also no word yet on the potential end date of the PEPP, which is set to end in March next year. And as I think we said, we don't expect any significant announcement on that front until the September meeting, which looks like it's going to be a very key one for markets. If inflation continues to surprise to the upside between now and then, I think we could get news of maybe an unwinding in these stimulus measures from the ECB. But interest rate hikes certainly remain a long way off in Europe. Finally, the Bank of England and the BOE, I think, has been slightly more hawkish than some of its peers of late. Governor Andrew Bailey has suggested, again, similar to the FOMC, that this increase in inflation that we've had is likely to prove temporary, but that the Bank of England would act if prices were sustained above the central bank's 2% target. The growth in inflation forecasts were revised upwards in May. The Bank of England also lowered the pace of its weekly asset purchases under its QE program. Some have called this a tapering of the QE program. I think it's more of a sort of technical measure, really, to ensure that the program doesn't run dry by the end of the year. But as Enrique has mentioned, we're of the opinion that the Bank of England may well be the first of these three major G3 central banks in order to reduce its asset purchasing target and perhaps raise interest rates as well. And we've had comments out, I believe, in the last couple of days from the Bank of England chief economist, Andy Haldane, who's going to leave the MPC at the end of this month. But he suggests that there is a risk that inflation in the UK could skyrocket if the accommodative policy is maintained for too long. And we'll find out the broader thinking among the MPC in a couple of weeks' time. On the 24th of June is the next meeting. There won't be any economic projections. It won't be a Super Thursday meeting, as they call it. But I think we should get a decent idea as to the thinking among the MPC as to how their view on UK inflation and their potential response to that later in the year. As we said, I think the MPC could lead the Federal Reserve and the ECB in normalising policy. The market is not pricing in hikes until December 2022, but if the inflation data continues to surprise the upside, that could be brought forward and we could see hikes before then. And that certainly, I think, provides some room for upside for sterling, particularly given how well the UK economy has rebounded. Going to finish very quickly before we go into the questions on our general view for emerging market currencies. And I don't think our view on EM currencies has changed too much since our last global webinar. In fact, if we look at the performance of EM currencies as a whole, EM currency indexes have generally drifted higher since the beginning of the year. The MSCI Emerging Market Currency Index, I think, is up around about 2% since the start of the year, so it's only modest gains. And the performance actually has been rather idiosyncratic and rather mixed among these EM currencies. Some have managed to post decent gains, while others have sold off rather sharply. We're seeing a little bit of a trend whereby the currencies of those countries have not managed to rein in rates of virus contagion that have underperformed. The Peruvian new sol will be one that I would highlight. You can listen to our view on the new sol on our most recent podcast episode, FX Talk. That's been a currency that's sold off very sharply this year as a result of authorities there not being able to rein in rather devastating rates of virus contagion and fatalities. But we are seeing currencies that have both managed to reopen their economies and also are edging towards or have even begun raising interest rates. Those are the ones that have outperformed. The Brazilian real, for instance, rates there were increased in May. The Russian ruble, again, we saw hikes there in April, and I believe there's a meeting tomorrow where the market is pricing in a 50 basis point hike. So those currencies, I think, that are closer to raising interest rates, probably likely to be the ones that continue to outperform during the remainder of the year. And as I mentioned last year, we're still overall pretty bullish on emerging market currencies. We think that market conditions are conducive for additional gains in these high-risk currencies. We think that the rebound that we're witnessing in the global economy is good for risk appetite as vaccines are rolled out to a wider percentage of the population. As restrictions are unwound, as the economy rebounds, we think that should be supportive of these emerging market currencies at the expense of the lower risk safe havens. Also, EM economies and countries, we think, should catch up in their own vaccine rollouts. That's been one of the things that has prevented these EM currencies from rallying more than they already have. Has been the slightly slower vaccine rollouts that we're witnessing among developing nations. Once they catch up, we think that those economies should begin to be reopened, and that should be supportive of EM currencies. As we mentioned, commodity prices have continued to rebound. Oil prices in particular are significantly higher than where they were at the peak of the downturn last year. That's generally a good indicator for emerging market currencies, most of which are much more heavily reliant on the production of commodities than, say, the developed nations. And as we've been talking about in the last few slides, most major central banks are likely to keep their policy accommodative for some time yet. None are necessarily in a rush to hike interest rates in the immediate term, as long as interest rates among the major nations are low, particularly in the US and Eurozone. Again, that's generally a conducive environment for rallies in emerging market currencies. So we're generally optimistic that we'll see most EM currencies post gains against the US dollar over our forecast horizon, with a few exceptions. Okay, I think that's everything from us in terms of content. I think we're going to leave it open now to any questions that you might have. We didn't mention at the beginning, there is a chat function on Zoom. There is a little tab, chat tab at the bottom. So if you do have any questions, please feel free to put your questions in that chat or Q&A function at the bottom of the screen. If not, do you have any sort of final comments, Enrique, about everything we've covered? Any final wrap up? I think it's still on mute, sorry.
Yeah, the main comment I would have is that we're going now into traditionally slow trading months of the summer, where market participants take a holiday. And I think that the inflation numbers of the next 3 months are going to be particularly critical to see if as we think, central banks in the developed world are being too relaxed about inflationary pressures. And so the CPI reports, the HIPC inflation reports in the Eurozone, and perhaps also the ISM reports on inflationary pressures as reported by business managers are going to be the most important data point of the next 3 months. And if, as we expect, we don't see any significant easing on either one of them, we can expect to have a rather hot discussions in both the European Central Bank, the Federal Reserve, and also the Bank of England in their September meetings after the holidays. And that will be my final thought.
Okay, perfect.
Thank you.
I see that there's actually
a
question
there's a
that
question.
came in.
I'd like to ask something about the G7 minimum tax of 15% for major tech giants. We think it's meaningful. We think that the trend over the last few decades towards lower taxation of capital in general, and in particular businesses, has probably run its course, and any changes that we're going to see will be towards higher. But we think that there's a long road ahead. We think that this is something for the next decades rather than months or even years, and the immediate or medium-term impact on markets, on inflation, on currencies, etc., of this global very slow trend towards higher taxes has just started and will take many years to filter through to any significant impact on economics or markets. So it is a significant step, but we're still many years away from it having a significant impact on the markets.
Okay. Well, I guess if there aren't any further questions, then I'd like to thank everyone very much for joining, and special thanks to Enrique and Matthew for presenting today. And yeah, keep an eye out for our next upcoming webinars. Thank you all very much.
Thank you. Bye-bye.
Thank you, everyone. Bye.